Hi everyone, I'm Paul and welcome to my review of ICT's 2022 Mentorship Program Lesson 7. I've been getting a lot of great feedback in the comments that these videos have been helping people to consolidate and clarify their learning, which is really excellent because that's why I've been doing these videos in the first place. So please keep those comments coming, like and subscribe, and let's jump into today's video. Today's video is Lesson 7 of ICT's Mentorship Program for 2022. And the outline for today's video is starting with daily bias and using the NASDAQ daily chart for the trade example. The next section is on a trader's mindset, and then the last section we'll be covering is consolidation hurdles and correlation between assets. Kicking off with daily bias, this is a topic that ICT's covered in a number of his videos before, and he often comments that his students or traders often get hung up on formulating their daily bias. This is sort of the quick and dirty version that he's gone through in this latest video, and the question we really want to ask is, where is price going to draw to? And this is how we ultimately determine our bias. And so how we do this is we look for price drawing to an old low or an old high, or draw to a bearish fair value gap or a bullish fair value gap. And until these conditions are met, then this is what our bias is. So this is a much more simple way of approaching bias. And obviously once you form your bias, until those conditions are met, that's what it is, regardless of what the market does or until your market structure changes. So this is the NASDAQ daily chart, which we're going to use to illustrate daily bias. And you can see from the chart that we're looking at a time period from October 2021 through to February 2022. Now this is, I guess, a trade setup as well as an analysis of daily bias. And so you can see the market from this swing low drives up into this liquidity up here. So we have these equal highs up here. So this is where our buy stops would reside. So remember, this is what retail traders would see as resistance. So they would be going short here and setting their buy stops above these relative equal highs here because they see it as resistance. So this is what we call our buy side liquidity. And so the market trades up into this zone. So we have this run into liquidity here. Before the market starts to fall backwards, we have a fair value gap form here. The market trades back into that zone before traveling lower. Now, the thing to keep in mind is from previous lessons, we've talked about displacement highs and displacement lows, and in between those is where we'll find the fair value gap. So this run into liquidity here, these buy stops, that's our displacement high, and our swing low here is our displacement low, and to the right of that you can see our fair value gap. So that's where we'd expect to find it. So once we're in this trade, the next logical thing to determine is where our exits would be. We'd be looking at the range high and the range low. So you can see using that 50% fib, we've marked that out from the low here to the top of the range here. And remember, we're looking for both our internal and external range liquidity. So at that 50% fib mark, that's where we expect to find approximately our internal range liquidity. And you can see that here. So we've got a fair value gap or an imbalance just here. And our external range liquidity would be at the lows, which is down here. So if we were in this trade, we'd be looking to take potentially partial profits at this first exit point, and then remaining profits at exit 2. So that's just a personal preference. You could obviously take all your profits here or hold out for the bigger move down here once the market trades back into this sell side liquidity down here. So that's how we would manage this setup on a daily basis. But obviously if we're looking to trade on an intraday basis, this would help us to formulate what our daily bias would be over the course of that period. So over the course of getting set in this fair value gap till the exit, our daily bias is going to be bearish. So we're expecting lower prices. Now that doesn't necessarily mean that every day is going to be a down close candle. You can see here in this move, this is quite a powerful move, and we have 2 up close candles in this whole sequence. However, over this period, we'd be looking at being bearish over this period. And so what that means for us on an intraday basis, we're looking for short trades to take advantage of that daily bias, but it doesn't mean that we can't take counter trend trades. So we could take bullish setups if we find them, but it just may be better to dial back the leverage or be a bit more conservative with those setups just because we are trading against our bias. So continuing on with our daily setup on the NASDAQ. You can see the market trades down into our second exit here. So we'd be out of this position once the market trades down into these sell stops, so into this sell side liquidity. So we know when the market runs into liquidity like it does here, it's likely to either reverse in the opposite direction or consolidate. And so what happens here is we have the market trading in a discount before going back into a premium market. This is just using a fib to mark out the range of this move. So you can see we trade back into a premium before going back down into a discount again. And so the question becomes, when we're in this ranging type behavior, how do we determine our bias? Now the simple answer is sometimes we just need to give the market more time. We need to see more price action before we can start to create a better picture of what's happening in the marketplace. And so when we have the market hanging around this equilibrium level like this, it can be very hard to determine bias, but this doesn't mean that there's no trading during this period. We just need to be more nimble. We need to be looking for price running into these liquidity zones and taking out previous highs or lows for us to get set into our positions. So before we continue on with our trade examples, it's a good time, I think, to talk about a trader's mindset. This next section resonates quite strongly with me at the moment because I'm in the process of building and testing a fair value gap trading system for Bitcoin or cryptocurrencies in general, based on ICT's teachings from this mentorship program. And so the first point is to embrace uncertainty. Something we need to accept as traders is that as much as we'd like to think we can predict what's going to happen in the market, is that often we get surprised or completely caught out. We ultimately really can't predict what is going to happen in the marketplace. We're just making a best guess. And so often it's easy to get paralyzed by that uncertainty and just fail to take any action. And so part of everyone's development as a trader is just embracing that uncertainty, just understanding that there's only so much we can do, and we're just trying to put ourselves in the best position. Until as a trader you learn to embrace that uncertainty and pull the trigger or press that button, it's always going to be a brake on your learning. And so you have to learn to embrace and accept that uncertainty to be able to make progress moving forward as a trader. And so the second point follows that you don't have to be right to be profitable. It's really common as humans to just always want to be right all the time. And the reality in trading is that that's just not going to happen. There's many traders who have trading systems that are below 50% profitable trades and still have very profitable systems. And so I think that's also another one of these big fallacies or breaks that newer traders especially get caught up in, is just wanting to be right all the time, wanting to get every single trade right. And the reality is that's just not going to happen. And so part of this is, again, embracing that uncertainty, is that you're not going to have to be right all the time to be profitable. And ultimately, being profitable is much more important than being right. And so part of the journey to becoming a long-term successful trader is practicing imperfect action. On our journey to becoming a successful trader, you're not going to be operating perfectly in the market all the time. You're not going to get the perfect entry. You're not going to use the perfect quantity. You're not going to take the perfect exit. And so embracing that imperfect action as part of that process, in terms of understanding you're not always going to be right, you don't always know exactly what the market's going to do, is important for just moving forward. But in saying that, as traders, we have to expect the highest standards of ourselves in the things we can control. And that's why trading with a system is so important, is because there are things that you can control and you can get better at and you can try to perfect, which will increase your chance of being successful in the marketplace. And so that's why having a specific setup like a fair value gap is important, because it tells you where your entry is, where your stop is, so that allows you to calculate your risk. And these are the things that you can improve over time. And so if you're very diligent about keeping trading records and keeping a log of your mistakes in terms of your trading behavior, you will be able to improve the things you can control over time. And so then you're leaving just a smaller window for things that you can't control. And this is ultimately going to lead to you being more profitable and being able to predict with better certainty what your system is going to produce over time and ultimately be profitable. And so if we can do these things over time and be consistent, this is going to help us to become indifferent to our results. Now, what I mean is, it's not that we don't care what those results will be. We obviously do care. We want to be profitable. We want to try and get as many, right trades as we can. But what we want to do is, numb ourselves to the outcome. And so what that means is that when we put a trade on, if we've done everything completely right, we put our limit where we wanted it to be, we put our stop where we wanted it to be, we got our risk and position sizing all correct, even if the trade doesn't go our favor and it's not profitable, in effect, that's still a good trade, even though we didn't get a profit, because we've kept to the system, and we know if we keep to the system that over time we're going to get the results that the system has gotten before. And so this is going to help us to be indifferent, and in those times when we're in drawdown, we can then look back at our mistakes and use that to make sure that we're following the system correctly. And this is what helps us to be profitable over the long term, is being consistent. And most importantly, not becoming emotionally attached to our trading. And this is because it's often our emotions which are most damaging to our trading. We want to make it as mechanical as possible. And so the question then is, we have this period of consolidation, we're looking to trade on an intraday basis. And so then how do we take positions when we don't really have a bias to work with? And that's what ICT is calling this consolidation hurdle. And this is where we now look at correlated assets to give us an indication of where we should take position. So in this case, we're trading the NASDAQ, but we're going to be looking at the S&P as potentially a trigger or an indicator to get a position set on the NASDAQ. So to illustrate this example, we're using the NASDAQ on the 8th of February 2022. And so this is an example of a long setup that ICT took. So he took that position down here once there'd been this run into liquidity. So you can see he took his long position down here, and using the fib to trace the extent of the move, so that's the range, top of the range from here to here, at that 50% mark, you can see we've got this fair value gap over here to the left. And also reinforcing, that as a position to exit, we have these buy stops sitting here. So this is relatively equal highs. So we have this buy side liquidity here. So at this sort of 50% mark is where he took his exit. So there was the potential to exit at this external range liquidity here at the extent of the range, right where this buy side liquidity is sitting up here at this previous high. So we'll zoom a little closer now into the 2-minute chart and look at a little bit more detail of that setup that was presenting itself down here at this sell side liquidity. So in this example, I'm using the NDX because my data doesn't go back far enough. But this is effectively the same data on this 2-minute chart. So what we can see is the market trading down here into this previous low, into this sell side liquidity or sell stops. After this run down into this sell side liquidity, the market trades higher again, but it doesn't breach this previous short-term high. So you can see it's equal highs here, but it doesn't breach it before trading back down again and then trading up. Now in the process of trading higher, this fair value gap's formed. You can see it's formed here. So remember, it's our 3 candle setup. So 1, 2, 3, and the fair value gap for this bullish setup is between the high of the first candle and the low of the third candle, and the fair value gap's formed across the body of the second candle. So you can see it's formed there, but the market doesn't trade lower back into the fair value gap, so there's no opportunity to get set on the 2-minute chart for the NASDAQ based on this particular setup. Now ICT's also spoken about order blocks a little bit in terms of previous videos, and you can see these 2 candles here, which are the down candles before the up move. If we take either the high or the open of that particular candle, that would be potentially another limit that we could use to enter in that fair value gap zone. But because the market doesn't trade lower into that zone, we don't have the opportunity to get set with an order block entry either. And so in this example, this is where we can use the S&P as an indicator for our entry into the NASDAQ. So looking at the S&P on the 15-minute chart, we can see we have almost the same setup as we had on the NASDAQ. We have the buy side liquidity up here, and we have our sell side liquidity down here, and a run into that liquidity before the market trades higher. And you can see we also have that fair value gap sitting here at about that 50% level. Now the difference between the S&P and the NASDAQ is you can see this period after we run into liquidity is much choppier. The market has travelled up and down quite a lot more prior to this run down into liquidity here before this run higher. So we're going to zoom in again now to the 2-minute chart to see if we can find an entry on the S&P that we could have subsequently used for an entry onto our NASDAQ 2-minute chart. So again, I'm using the SPY here instead of the ES futures because my data doesn't go back, but you can see the setup and the candles are all going to be exactly the same. So we have this run down here into the sell side liquidity, so into these sell stops before the market trades higher. And you can see here, different to what happened on the NASDAQ, we do trade above that previous short-term high, which we didn't do on the NASDAQ, before trading back down and then trading higher again. So you can see in this particular setup, we do have a fair value gap set up after this run down into liquidity. So again, it's our 3-candle setup, so 1, 2, 3, and being a bullish fair value gap setup, the fair value gap is formed between the high of the first candle and the low of that third candle across the body of the second candle. And the difference being in this particular setup, you can see here on this candle here at 10:36, the market trades back down into that fair value gap before it trades higher. So this is the key difference we have here on this setup as opposed to the NASDAQ, is we have our break-in market structure, which we didn't have on the NASDAQ. We had our trade down into the fair value gap, which is the trigger for our entry if we were going to do it on the S&P, before the market trades higher. So as we've talked about in some of the previous lessons, our fair value gap is found here between our displacement low and our displacement high. We've had our break-in market structure. The market's then traded back into that fair value gap, which has allowed us to get set before the market's traded away. So keep in mind, we have an entry signal on the S&P at 10:36 here, trading into this fair value gap, and we can use this entry as an indicator for our entry on the NASDAQ. So let's jump back to the NASDAQ 2-minute chart, look at 10:36, and we can see where we potentially may have gotten set in that trade on the NASDAQ. So looking at our NASDAQ chart again now, we can see at 10:36, this is actually prior to the fair value gap forming on the NASDAQ, but it is within that order block that we talked about before in the video. So in terms of getting set on the NASDAQ here, we could have chosen any point in that order block to take our long position, and this is exactly what ICT said he did. So he took his position here and he exited at about 14,620, which was where that internal range liquidity was, that fair value gap, and also where those relative equal highs were located on the chart. I hope you enjoyed my review of ICT's 2022 Mentorship Program Lesson 7. In today's video, we covered daily bias and how to overcome consolidation hurdles using correlated assets. So I hope you found that useful. If you did, it'd be great if you could like this video because that'll help other people to find it. And if you're enjoying these videos, please make sure you subscribe to my channel. Thanks for watching, and I'll see you in the next video.